Hello and welcome to Tortle Ninja. Today, let's talk about derivatives in DeFi and why they're crucial within the DeFi landscape. At its core, derivatives are financial contracts that track the value of an underlying asset. It's similar to wagers, agreements based on the future price of the said asset. These assets come in the form of stocks, commodities, and in our case, cryptocurrencies. Since its rise in 2018 to 2019, numerous projects introduced decentralized futures and options platforms, giving users the opportunity to do complex financial transactions in a more open and free environment. So why are derivatives such an important part of the DeFi landscape now? Let's talk about some key reasons. The first is that it allows hedging. Investors can use derivatives to shield themselves from price fluctuations, which are very common in the crypto market. This risk mitigation strategy ensures minimal losses in case the market experiences a downturn. The second key point is speculation. Traders use derivatives to bet on an asset's price movement without needing to actually own it. They can profit from both rising and falling markets, giving them more trading opportunities. The last key point is liquidity. Derivatives have the potential to provide a lot of market liquidity. Increased liquidity means more buyers and sellers in the market and fewer price swings, improving the market's efficiency. Of course, there are still some challenges associated with derivatives, with the first being volatility. The crypto market is inherently volatile. Derivatives are even more so, and that poses either a big advantage or a significant risk to users. Another challenge is the risk of liquidation. In DeFi, liquidations occur automatically and without warning, potentially resulting in users losing all their funds during certain market swings. Tortle Ninja addresses these issues by offering tools like combo triggers to help DeFi users manage derivatives more effectively, reducing the need for constant manual monitoring. These triggers automatically respond to market conditions by analyzing news and on-chain data to execute preset actions. For example, if an asset's value drops, the triggers will protect a user's investments by executing a sell order, pausing token farming, etc. This ensures that these investments aren't affected by market downturns due to unforeseen events like volume events or black swan events. If you want to learn more about how these tools work, visit the link in our description. Thanks for watching! If you found this helpful, please like and share this video. Also, follow us on Twitter for more updates.